Alright, so this is kind of crazy, but interesting at the same time because so far this year, we are setting inflation record highs. Our central bank has promised to increase what's called the federal fund rate at 0.5% for the rest of the year, which also happens to be the fastest pace in the last 20 years. CNBC reports that Americans have started to dip into their savings accounts and that this year we have $9,000 less on average than we did the year before. Bloomberg reports there's a $5 trillion wealth shock thanks to the stock market having its worst start to the year since 1939. Crypto just lost $300 billion off its market cap last week thanks to the collapse of a stablecoin. The Wall Street Journal says that real estate growth is on borrowed time at this point. We got our first negative GDP reporting, which means we are halfway through starting a recession, and yet CNBC also reports we're nowhere near a recession. So things are bad, but ultimately they're good. Sometimes it's really hard to separate fact from fiction in the news these days, especially because the people that have a house to sell you will tell you now is a great time to buy, especially before interest rates go even higher. And the people that want clicks will tell you real estate's in a bubble, don't buy, it's about to collapse. So which one is it? A few of my friends actually reached out to me this week to ask my opinion about real estate, and the first thing I told them was that, you realize I beg people to smash the like button for a living, right? I'm not a real estate expert, I'm not a financial advisor, and I've got nothing to sell you, but I think that the truth is probably somewhere in the middle. And in today's video, I want to share with you some new market data, which hopefully sheds some light on what's actually going on without a hidden agenda. So if that sounds exciting, let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the data. So once again, I have enough skin in the game with real estate to know a little bit of what I'm talking about, but I don't have 20 years of extensive experience, 15 rental units, and an agenda to prove to you how real estate is gonna go bananas. My only qualification is that I bought my first house last year in February. I bought another house this year at a 2.6% adjustable rate mortgage. So technically, I already made money on the loan as well as the house, but going forward, I don't think that kind of growth is gonna be sustainable, and I think the market has already started to soften. So I wanted to show you some data that helps support that observation. The most obvious observation that I found is that I don't think anyone could have predicted just how crazy real estate would explode in value. For example, before the recession in 2020, the median home value was $329,000. Today, it's closer to $429,000, which is a 30.4% increase in just the last 2 years, which is especially crazy when you remember that real estate should typically grow anywhere between 3 to 5% in a normal year. But looking back at everything, hindsight is 2020, and it's kind of obvious how it happened the way that it did, because we dropped the federal fund rate to zero and we printed more money than we ever have before. In 2020, we had $15 trillion, and today we have over $21 trillion. Now hold on, to put in perspective just how crazy that number is, that is a 40% increase of all the money that has ever existed in just the last 2 years. So of course, the price of materials, the cost of labor, and supply chain problems made everything more expensive. Combine that with hedge funds chasing yields which they couldn't find because interest rates were close to zero, which forced them to buy residential real estate to give themselves any kind of a return. That made the problem even worse. Combine that with stocks and crypto and other asset classes going up in value like crazy, which gave us more confidence because it made us richer on paper, which meant we went out and spent more money, which made the problem of inflation even worse. So now we find ourselves here, where the market is correcting big time, but real estate hasn't, which is weird because normally when interest rates are low, you can expect to pay a little bit more for a house because there's more people competing and they put up higher offers. But when interest rates are high, like they are now, you should expect for prices to be lower because people can afford less, so they make lower offers, so inventory goes up, prices go down to meet demand. But they haven't yet, which is weird. So the question is it better to buy now or is it better to wait? So first, let's address the elephant in the room, which of course are interest rates. The national average for mortgage interest rates on a 30-year fixed rate mortgage has gone up to 5.25%. And because of that, a few really interesting things have started to happen. One thing that really stood out to me is that mortgage payments have gone up 44% year over year, to the point where now the median monthly payment on a new home purchase has gone up to $2,427 a month, which is especially crazy when you remember the fact that last year that same exact house was going for less than $1,500 a month. And because of that, we've started buying fewer homes, which is also why mortgage applications for new home purchases have gone down 2.4% when compared to the month before, and down 10.6% when compared to the same April last year. And the reason that I say April, by the way, is because our numbers are always lagging 1 month behind. So when May's numbers come out in June, it'll definitely be worse, because remember, the federal fund rate was increased this month on May 4th. So the people that bought in April got that better rate, and the people buying after are not going to get as good of a rate, which is also why competition is going to be lower, which has already dropped to the lowest levels in over a year. Now, 60.7% of homes have competing offers, and the last time the numbers were that low was last year in March. Now, don't get me wrong, 60.7% is still really high. That means the majority of homes for sale have multiple offers, but the numbers are already starting to go down, partially because our inventory is also going up. For example, last month at the end of April, there were 1.03 million homes for sale, but that was already a 10.8% increase from the month before. So we are slowly starting to build up inventory, which usually means a softening of the market. Another interesting statistic that I found is the amount of new home buyers entering the market has also started to shrink. We are now at 28% of first-time home buyers, which is down from 31% a year ago. Now, that's not a huge drop, but you also have to remember that we just started to raise interest rates, which means that number will probably continue to go down as the Fed plays catch up. Now, I just threw a ton of data at you, so let me mix it all together and interpret what the data actually means as far as the price of where we're actually going. Even though interest rates are going up, even though the amount of homes for sale is going up, even though the amount of homes we've sold is going down, even though the amount of buyers buying homes is going down, prices are still going up. It's crazy because if you were to tell someone everything I just told you under normal market conditions, they would 100% bet on homes to go down in value. But they haven't yet. In fact, the median price of existing home sales is $391,000 as compared to last year's April when it was closer to $303,600. It's crazy. It's hard to make sense of it all, especially if you try looking at this chart. Homes are selling just as fast this year in April as they did last year, with an average of only 17 days on the market. Sales to investors are also the same as they were last year at 17%, and cash sales are up 1% from last year. 88% of all homes that were sold last month were listed on the market for less than a month. 88%, it's crazy. So yes, even though inventory is going up 10.8% from March, which usually means prices go down, that's not saying much because we are still down 10.4% from last year's April. So we barely have any homes left for sale. Now, my question is this price growth sustainable, or are we gonna go down? Before I give you my personal thoughts, first let's ask the experts, because I'm not one of those. Business Insider asked 32 real estate professionals exactly this same question, and 4 of them said maybe, 6 of them said yes, the market will correct, and 22 said the market will not correct at all. So now let me give you my personal thoughts about where real estate is going and what I would do if I was shopping for a house today. I'm not convinced that we're in a bubble in the sense that prices will crash like they did in 2008, but I'm also not convinced that prices will continue growing at this crazy rate. The biggest mistake that I'm seeing people make right now is the assumption that because our inventory is low and demand is high, that everything's gonna be a-okay and it will continue to stay that way. Because demand is too soft of a metric to rely on. It can change faster than the time it takes for you to smash the like button. But here's what I mean. The tech layoffs and hiring freezes have already started to happen. And if that spills over into other industries and other companies like Target and Walmart, for example, which have already started to report horrible earnings, then we could see a shift from full-time to part-time to no time. And that would be horrible because if people lose their incomes, then obviously that demand would vanish faster then I could vanish this playing card right here. Huh? Should have been a magician. On the other hand though, here's a very interesting way to look at real estate in a way I think most people don't even think about. Right now, on a global level, US real estate is still actually very cheap, which I know is crazy to say, but let me prove it to you. Because on average, here in the US, when people buy a house, they would spend 4.5 times what they make per year. Now, obviously, certain places of the US are a lot more expensive, like LA, which is closer to 8.7, and other places are cheaper, like Cleveland, which are closer to 1.8, but the average is about 4.5. Now, to put that in perspective, other parts of the world, like for example, Vancouver, is 11 times. Kingston is 16 times what people make in a year. And in certain parts of China, it's in excess of 30 plus. So when you think about it, even though we are at 4.5, which feels expensive to us, on a global level, that is still very, very cheap, which is partially why we have these hedge funds and international buyers with money that have been buying our real estate for so long. Because even at these higher rates and higher prices, that is still cheap on a global level. Add to the mix that millennials are coming of age and we need to buy a house, and we actually make enough income now to buy a house. Even if prices fall, I think we have a lot of support even at these levels, and if prices fall, I think it'll be temporary anyway. So I think a more nuanced answer is that it depends on where you live. If you live in those more expensive cities that have experienced the highest levels of growth relative to people's incomes, then those are the cities that are the most exposed to falling prices. And here's a map of some of those cities. Now, if you live in the cheaper cities, then you are obviously more protected. Personally, I put my money where my mouth is, and I took out a 7-year ARM, adjustable rate mortgage, which is that in 7 years from now, whatever the rate is, that's the rate I'll be locked in at. I took out as big of a loan as I could afford. That's the key, as big of a loan as I could afford. And it is my belief, and I could be totally wrong, but I believe that 7 years from now, rates will be lower than they are today. Because I believe that our government and our corporations are addicted to cheap money. We use low interest rates to stimulate growth, and our politicians love to use that mechanism of interest rates to win elections. And you can see these cycles of boom and bust in politics all the time. In fact, if you look at our historic interest rates over the last few decades, you can see for yourself that rates like to stay closer to zero. And that's because, once again, we love cheap money, and I don't think that addiction is going to change anytime soon. But sure, sometimes we will have to raise rates like we are right now to slow down inflation. But the bet that I made is that 7 years from now, rates will go back closer to zero, or at least lower than what they are today. And I could be wrong. And that's okay, because that's why I took out a loan that I could afford even with the higher rates. But if I was in the market to buy a house today, then I would probably buy as long as I could afford it. I would put down as least amount of money possible up front, even if it means paying the PMI temporarily, as long as I could afford it, because my bet is that rates will be lower in the future, at which point I could refinance, get the lower rate, and if I'm still annoyed by the PMI, I could pay the difference of 20% to get rid of it. But if there is one thing I would wait for, is I would hold off on buying my dream house. Instead, I would buy my starter home knowing I could live in it for just a few years, because the last thing I want to do is overextend myself buying a dream house at these crazy high prices and higher interest rates, because if prices fall, or God forbid I lose my income, things could go bad. So I would buy today as long as I had a stable job, I had a cash cushion, and I could afford it. But the last thing I would do is buy my dream house, and now is not the market to overextend yourself. So that's how I would play real estate, but I could be wrong. And please remember, I beg people to smash the like button for a living. If you want to double check my sources and where I got my data, all the links are down below. But in the meantime, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Go grab up to $250 worth of free Bitcoin right here. Grab your free stonks, links are down below, and then go track them automatically with the spreadsheet linked down below in my Patreon. Love you, thank you so much for watching. I'll see you back here on Monday and Friday, sometimes a Wednesday. I'd love to know your thoughts. I'll see you soon, bye-bye.